Hi, this is Andy Flipiak in Toronto for the week of August the 7th. One of the questions that's been hard to answer and is baffling many analysts is just why the U.S. stock market and the U.S. economy, for that matter, have been so strong since the start of this year, given the fact that interest rates have continued to rise and are putting real pressure in the credit markets. And the simple answer is the huge amount of fiscal spending that the U.S. government has been doing. Now, I came across a great website. I've included the link for viewers here called Quoth the Raven. And in that, he takes data provided by Larry Lampert, a portfolio manager, that shows some very interesting developments. First of all, the U.S. is now paying over $1 trillion annually on interest expense. Because the debt's gone up so high, coupled with the sharp rise in interest rates, the U.S. now pays over $1 trillion, and this situation is going to get worse. Over this year and next year, there's an additional $9 trillion of bonds that are going to be maturing, and they're probably going to be rolled over at roughly 5.3% in that range. It's important to point out 2 years ago, the rate would have been less than 0.5% that the government was paying on that. So the rise in rates is really contributing a huge amount to the budget deficit that the U.S. is currently running. One other point is that now interest expense is actually higher than the military budget. Now, looking at the fiscal deficit that the U.S. is currently running, it's going to come in at around $2.25 trillion. And if you look at that compared to the U.S. economy, which is around $26.5 trillion, that's over an 8% budget deficit, which is huge given we're not in a recession. So when you see those types of numbers, there's no doubt that financial markets get very, very worried, and that can result in a selling of the US dollar and a selling of US bonds. Now, it's important to note when you're looking at these size deficits, I mean, the US government is going to have to raise roughly 2.2 or maybe even higher, because the Fed's still selling off its balance sheet, $1 trillion in bonds. Now, where's that money going to come from? In the past, foreign buyers such as China and Japan would have picked up a large chunk of that potentially. But since 2014, foreign buyers have been net sellers of U.S. treasuries as opposed to buyers. So when one looks at this, we could be seeing where the Federal Reserve has to unwind its current quantitative tightening and start to buy U.S. bonds in order to fund the U.S. deficit. And what this means is, instead of fighting inflation, you're actually creating it, or help create it rather, by having to print more and more money. So we've reached the point where, ironically, the rising of interest rates created by the Fed is actually going to lead to higher inflation going forward. And this situation is totally unsustainable. We don't know when it will be rectified, but markets will deal with this situation. For investors, it means capital flows are going to continue to slowly come out of paper fiat currencies and government bonds and work into hard or tangible assets going forward. Thanks for watching.